The S&P 500 is now only down 10.77% year to date. It was down as much as over 23% at one point this year. The Nasdaq down 17.79% this year so far, and it was down as much as over 32% at one point, so way off its lows. And so maybe things are better, maybe they're not, but at the end of the day, do we really care? If we're long-term investors, does it really matter? Look at how many times there have been to not invest. Notice the upward trending red line here, and look at all the times and all the excuses people had not to invest. The Bay of Pigs, the Cuban Missile Crisis, the Vietnam War, Soviet Union collapses, World Trade Center bombing, Oklahoma City bombing, 9/11, oil prices surge, bank crisis, housing bust, a global pandemic, and right now, a recession. Or at least a debatable recession. Well, let's call it at least we have inflation. And so, what I wanted to do today is talk about 3 stocks that I like right now, even amidst all of the madness that's going on. Now, I think I have a pretty good list of stocks today for you. Actually, not all of these are growth stocks, not all of them are value stocks / dividend stocks. 2 are actually dividend stocks, 1 is a growth stock, so we're giving some diversification today. So let's start with the first stock. So the first company I have for you today is Verizon. Now, Verizon is a stock that I've talked about before. I've made videos on how much I think the stock is worth, and I still like how much it's selling for. Now, if you look at marketbeat.com, you can see analysts have a hold on this, but there's an upside of 25.1% according to this website, which is $56.50 price target. I actually have a higher price target than that, which I'm going to show you in a second. There's still projected earnings growth of 3.08%, and of course, this is a great dividend paying stock. Verizon pays a 5.67% dividend yield. I mean, that is a very healthy, nice dividend yield. Of course, you could say the price is down too far, but I like the price as well. I think it should be higher. So I think that you get a nice dividend yield right now, and I think the price should actually be higher for the stock. Throw in the fact that the actual 10-year treasury is not even yielding this much money, and you're getting a good risk premium for the stock. Annualized growth of dividend over the past 3 years has been 2.05%. It's grown its dividend 18 years in a row. It's got a dividend payout ratio of 51.30%. Now you can go back and look at my valuation on this stock. I did an entire video on it so you can see everything I went through. I'll tell you my price target for it. So I have a $68 price target for Verizon. It is an upside potential right now, if I'm correct, of 49.84%. So that's what I think the stock is worth. And look, if you don't like the fact that I did, let's say, a dividend discount model here, which maybe that's the one that's the weakest, that's the highest also as a target price, even if you take this out, you can see that I still have a $62 price target with a 36.8% potential increase in this stock. That's my target, and if we take out the dividend discount model. So at the end of the day, I think this stock is a good buy. I actually own this stock. Back in 1999, Verizon sold for as much as $63 per share, and it's currently selling for $45 per share. So if you had bought this stock back in the late 90s, you would have had a terrible, terrible return. You can see a very scary, very large head and shoulders formation, which is bearish. That did not end up well for this stock, and it has now been in an uptrend since about 2010, as you can see here. And we just dipped below that uptrend. So what I'm wondering is it going to get back above this uptrend, or is it going to stay below it? Now we're zooming into a 1 year, and I'm on a day chart here. And so what you can see is big gaps down here. This is that big uptrend that I showed you before, and this is some resistance that I see here. So what do I see for this stock potentially going forward? Well, first off, MACD is very low, and you have the oscillators turning green there. I like it. Then you have some RSI that's pretty low. It's not quite oversold yet, but it is pretty low there, so not bad. So in the short term, I think that this looks pretty good for the stock. Now, it has some resistance up here in 49, then it has that trend line that we talked about before at about 52. So if we look at how much this would be, if we had an increase in here, it would be 8.63%. If it made it up to this little resistance area, and it made it up to the trend line, it could be around a 15% return. Of course, I think the stock can go higher, so it's going to be up there in the 30+% range if I'm correct. You get a nice dividend along the way. If I'm wrong, at least you get the dividend. So, okay, that's the first one. Let's go on to the next one. Our next stock is Exxon Mobil. Now, I did a whole video on Exxon Mobil, so you can, of course, go back and see what I did there. So, Exxon Mobil has a dividend yield of 3.74%. It has annualized growth in its dividend of 2.61%, a dividend payout ratio of 38.51%. 38 years of a dividend track record, so this thing has been paying dividends for a very long time. As you can see going back, the dividend yield back in December of 2020 was 11%. So this thing got really crazy along the way because oil prices went down so far, and at one point it was basically essentially negative, and you could see that this company still paid a dividend, so that is amazing. So through tons of volatility, ExxonMobil still paid a dividend. I like that. That's a good check in my book. Now, I don't own this one. Now, the reason I don't own this is because I have a lot of exposure to the general energy sector. Now, I have that through an ETF. It's called XLE, and I also have different stocks that I bought through a screener, and quite a few energy stocks did hop in there when I did that screener. So I do have some energy exposure, and I don't want to add any more to it, but I do like this stock in general because I am still bullish on oil. So in terms of oil, it is very important the price of crude oil with this company because it's correlated to crude oil. So ExxonMobil, if you see here, is the candlesticks, and this orange line chart is actually the price of West Texas Intermediate crude oil. And as you can see, there's correlation between the price of oil and the stock of ExxonMobil. As you can see, this is going back until about 2006. We have a big uptrend here, and you can see the big uptrend in this orange line, downtrend here during the time when it was 2008, that big recession, the Great Recession. Then you have building back up to April of 2000 level, where you can see ExxonMobil price is coming up here, and of course you have WTI crude oil as well coming up here pretty high, the second highest price on this chart almost. If you take out the most recent high that we just hit, which was the second highest price of crude oil on this chart. Then, of course, down here, we had a big tank in crude oil. It goes down, it goes down, it goes down. See how long it stays down here, and then it bottoms out here when the pandemic hits, and then it goes on a tear. And there are a lot of people who say, well, it's probably going to have the same thing happen to it. It goes up, and then it's just going to come down. It's going to stay down for a while. Now, I don't think that's going to happen because I don't think supply is there right now, and I think there's going to have to be a lot of capital put into this entire industry to get it to the point where it meets demand, essentially. And that's why I think this company still has a lot of runway in the next, let's say, 3-4 years. So you get that decent dividend yield, you get a potential price increase in the stock. I don't think it's going to be hurt very badly. I don't think oil prices are going to very much decline under, let's say, $60 a barrel, probably under $80 a barrel on average. So I think this is going to be a fine stock to own over the next few years. In terms of the price target I have on this company, I did a discounted cash flow, I did a discounted earnings per share, and I did a price to sales valuation, and I got $110 as the stock price for this company. It would give you a 16% upside right now if you held it until it hits that price. Okay, so the final stock we got today is Crocs. Now, I just made a video on Crocs, so you may not be surprised about this one, but check out my whole analysis on that video if you want to. Crocs has a moderate buy rating according to Market Beat. It's got an upside of 20.9% now. I think that this stock has a higher upside than this, so I will show you in a second. It's got projected earnings of 7.65%. This company does not pay a dividend. However, let's take a look at some of the competitors. We're going to see some interesting things. Look at Deckers. Deckers here with a market cap of $8.6 billion, revenue of $3.15 billion, a PE ratio of 20.14. Now, let's compare this to what we have here for Crocs. Crocs has a PE ratio of 8.90, more than half of Deckers. So do you like Deckers? Do you like Crocs? Valuation-wise, I like Crocs. I think that they definitely have a popular shoe, two different brands of shoes that can go pretty far. The market cap of Crocs is $4.81 billion. Like I said before, $8.6 billion for Deckers, about 2 times almost the size of a company. So what do I think? Well, I think that Crocs is undervalued. We can also see Under Armour here. It's got a market cap of $4.65 billion, so very close to Crocs. It's got revenue of $5.68 billion and a PE ratio of 27. Crocs has a PE ratio of around 8, so very much more expensive to own Under Armour than Crocs, and I think Crocs has a lot of runway to grow. If we come over to what I think it's actually worth here, we have my price to free cash flow that I did and the EV to EBITDA valuation. I weighted these 60-40, $141 target for the free cash flow and EV to EBITDA 163. That gave me a $150 price target for this company. That's a 92% increase in the stock price. Now, I might be wrong on this one, but even if I'm wrong by a little bit, at least I think that this stock should have an increase in value from these low levels. Now, don't invest in this stock thinking that it's a non-volatile stock and it's just going to go up. There's going to be a lot of moving around in a company like this. And the reason is the market has some madness of sentiment going towards it. From the peak to the trough, as you can see right here, negative 75% from that time period over here in about November of 2021 all the way down until this bottom out here, and let's say a few months ago. Now the thing is up. We'll call it around 71% from those bottom levels. And so these are base effects. So when you get a stock that's fallen this far, little bits of jumps are going to have huge gains. So of course, I don't think it's going to go back to this price that it was at its highs anytime soon. So I'm saying is I think Crocs was oversold and it still has time to go up. And I don't think, of course, it's going to go up to that high that it was at anytime soon. I do think it's going to go up to a decent level here, which is $150 per share. And of course, it could be a little bit under that. So even if it's $100 a share, stock has a decent run up. I will say in the short term though, this company doesn't look like it's so great in terms of, let's say, the indicators. We have MACD getting pretty high, and we have an oscillator that's declining, and then we have some pretty decently high RSI. Not quite oversold or overbought yet, but it's getting up there. It is inside this short-term uptrend channel, broke it out of this short-term downtrend channel, so that is good. And that's all I have for today. So I own Verizon, I own Crocs, I don't own Exxon Mobil, but I do think that one's also a good stock right now at this point in time when I'm making this video. So thank you for watching. Hit that like button if you like this video. Subscribe if you want to see more videos like this, and watch another one of my videos on the end screen coming up right now. Thanks everyone so much for watching. I do want to remind you I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence.